thank you for tuning in to DNV Market Views, our videocast where we discuss the latest market developments. And it's all about disruptions today. Disruptive technologies, energy transition, turbulent geopolitics, or operational complications. All these dilemmas make the most of the headlines we read these days. One would say there is a fundamental lack of predictability, making investment in the shipping industry more challenging. Buying or operating a ship has become much more complex than just a few decades ago. What design should one go for? What financial vehicles should be applied? And how does one stay competitive in a market that often requires contradictory measures, like cost efficiency versus additional investment in green technologies? And speaking of which, how disruptive these new technologies will be? Is decarbonization leading us to a similar sail to steam or steam to diesel transformation? A frequently used slogan, future-proof assets, is limiting risk and reducing unpredictability possible, or are we just quietly comforting our rattled nerves? Perhaps the recipe for the future success lies in the events from the past. I'm delighted and privileged to welcome Dr. Martin Stopford, one of the most well-known people in the shipping industry, an economist, teacher, writer, regular speaker and a business manager who's often quoted by major publications such as The Economist, Financial Times, Bloomberg or Lloyd's List. Martin's book, Maritime Economics, has become a must-study for everyone who wants to understand how this industry works. And I can tell you a little secret, a new edition of the book is coming soon. Yet, Martin was kind enough to put the writing on hold and join us in sharing the views about disruptive reality of shipping. So we sat in a little studio and chatted for perhaps a little bit longer than we initially thought we would. As a result, we had to split this episode into two parts. And today's part will focus on the current operational, commercial and geopolitical disruptions we read about daily. So how does it influence shipping and how does it change our short-term perspective? I hope you'll enjoy the show. My name is Jakub Walenkiewicz and you're watching DNV Market Views. Martin, welcome to the show. I'm really delighted you are today with us, and tell me, how is the writing going?
Oh, well, thank you, Jakub, for that introduction. The writing, well, it's sweet and sour exercise, really. The wonderful thing about having a book like Maritime Economics is that it tries to cover everything, and so updating it is not just a matter of changing a few numbers. You have to revisit each subject and understand how it's changing, and that's what I'm struggling with at the moment. I've got a very patient editor, I've got a plan, and I'm trying to do a chapter a month, but it's I keep breaking off to do interesting things like this, you know.
Oh, one of those being with us today. Thank you
Absolutely.
very much. And well, as you said, it's not only updating, and those disruptions which I just mentioned are very much, I would guess, a part of your the future edition, because you need to add so much more now compared to what we had in, let's say, 20, 30 years ago, right?
Well, that's a very perceptive point, because I'm now on the fourth edition, but I would say the first three editions were done. The first was in '88, so it's over it's 30 years, and that was quite a stable period in shipping. And so the updates, the previous two updates, didn't have to rethink the models, work the models too hard. But we're now, as you've just mentioned so clearly, we're moving into a different era. I mean, after 50 years of quite stable economics, if you like, we're seeing a whole new dimension of the models emerging.
I think since we talk about disruptions today, and very much addition to your book anyway, was coming up, let's say, in the fall, I sort of look at it, and then you just never get bored these days. And then we've got all sort of disruptions. But I mean, let's start with something that is more operational and what we've sort of experienced over the past few years. And I guess you can call those things like a choke points. That's what I'm alluding. So, and it's in principle, those violent changes for shipping in terms of trade. Let it be Suez Canal, let it be conflict in Ukraine, let it be Panama Canal. I mean, how do you see those? I mean, everyone is obviously looking into obvious things. It creates a massive spikes of earnings for ships, which shipping predominantly is quite chuffed about it, right? It's a huge accumulation of capital these days in shipping. But I mean, those things happened in the past already. Let's take Suez for a moment. How do you see this situation today being similar or perhaps different to what it was, let's say, 60s and 70s?
Well, we've been through these sort of events fairly regularly. I mean, the first Suez was 1956, and that completely closed the canal at a time when all the tankers went through the canal, and so that was a very major disruption. And they, instead of going around the canal, they had to go around the Cape, and it really caused, first of all, a very tight market, which, I mean, Aristotle Onassis was famous for making, I believe he made $800 million in 6 months in 1956, because he at the time, most of the tanker fleet was on time charter. But Onassis, who had a bit of a run-in with the oil companies, his ships were all sitting waiting, and so when the market went up, he suddenly was swept along on this pile of cash coming in. And of course, the thing about the shipping market is that the upside is much bigger than the downside. I mean, the downside, you go down to OPEX, which is a little way. The upside is really what somebody is prepared to pay. And of course, in 1956, with empty oil refineries, they were prepared to pay a lot of money. So there was that particular event was very disruptive. But after about a year, the market got used to it. And indeed, contrary to expectations, the Egyptians cleared the canal. I mean, this is one of the great... It just shows how hard it is to predict these things. Everybody thought... I think the consensus in 1956 was that the canal wouldn't open for 3 or 4 years. The reality was, because it was blocked with ships. I mean, NASA had sunk ships in the canal to block it. The reality was that they cleared the ships in a few months, and I think, from memory, it reopened in April 1957.
Yeah, I think there was
a
long break. Yeah,
and so the market then immediately collapsed. And if you were lucky, you'd fixed your ships at the top of the market. If not, it's entered a very long recession, and the canal stayed open until 1966, when it closed again. By which time the market had built lots of VLCCs that went round the Cape anyway. I mean, there's so many inflections on how these things develop,
But then, yeah, exactly. But then, by then, we talk about 50s, 60s, 70s, predominantly oil markets affected. You didn't have any container trade going through Suez. I mean, it's only the beginnings of containerizations. Like today, we see a completely different dynamics. It's not about oil tankers. In fact, it's the LNGs that go the other way around the Cape. Container traffic, I think, is down by 80%. Car carriers. So it seems to have a much bigger impact compared to what it was, let's say, 3-4 decades ago.
Well, yes, it stands to reason. You build your ships for a particular transport system. If it changes, that is unfortunate. But the great achievement of the shipping economy is that it has the knack of adapting. I mean, we had all this kerfuffle with the containers after COVID, and it was bound to happen. You suddenly find that you've got a dominant charterer, like a dominant cargo source like China, and suddenly they stop shipping for 6 months, and you're bound to have logistics problems. What is perhaps the most striking thing about that was that the market, it went very tight for a while, and it taught shippers a few things about what containerization could cost. You're suddenly paying $70,000 for a container, and it makes that point. But in the end, the things sorted themselves out and the logistics got back to normal. And I think perhaps one shouldn't underestimate the value that the market is bringing by its ability to move resources around and of course, the great motivator there is you pay $70,000.
Yeah, that's a good incentive, isn't
it? and you're pushing things. That's the unique thing about shipping. It really is a market-driven business.
Yeah, oh, absolutely. And it's so compartmentalized in many ways, and it's decentralized, and it always finds its way to sort of adapt to the reality, which is what shipping is so great about. But I mean, I would talk a little bit more about those problems with current disruptions. Let's take Panama, for example. I mean, the Panama obviously for a long time had only one single locks, 32.2 meters. And there was a long discussion as we were obviously expanding Panama Canal to a completely new reality to let the bigger container vessels go past to gas carriers, right? Both VLGCs and LNGs. And now all of a sudden we've got let's call it a climate disruption, right? I mean, we run out of water. So we do see quite a bit of limited traffic through Panama for obvious reasons. But then we also sort of, when we geared up towards Panama, we came up with certain designs, the new Panamaxes, right? So much larger containers, up to 15,000 TEU, the 174,000 cubes LNGs and so forth. I'm just sort of, kind of thinking, and perhaps I'm completely wrong, but, I remember the ULCCs. Well, I don't remember, but I remember from the books is they were to some extent designed to avoid Suez. And perhaps I'm completely wrong on this one. So tell me, and I'm saying it will, but if Panama continues to have problems with its throughput, with its total capacity, isn't it a part of the capacity on the fleet we build I wouldn't like to call it obsolete, but at least not perfectly sort of optimized for the trade it will be doing?
Well, the ULCCs that you mention is this is very much a sort of ship focused problem. I mean, the oil companies built the oil transport system in the 60s and 70s by giving ship owners time charters to build bigger ships. And because they were moving the refining from the market, from the source of the oil to the marketplace. And so you wanted the biggest ship you could get. And after the Suez problem in 1956, that really underpinned the VLCC so the move to get much bigger ships, which were designed to go around the Cape, not to go through Suez. And so that developed in the 60s. And by the 70s, we had another of these, the oil crisis, the pre-oil crisis spike, when there was another round of very high rates and a lot of speculative building of VLCCs. But some of the independents took the step further. There was talk about a million-ton tanker at that time. Yeah. And quite a bit of independent money went on to VLCCs, but also the oil companies, who do their calculations very carefully, did develop designs for VLCCs on ULCCs on the ground that they would save so many cents a barrel. And that was a logical development of the economics of the of going from Aframax, Suezmax, VLCC, ULCC. It seemed a logical progression, but as it turned out, it was really a step too far for two reasons. The first is that the economies of scale with these big ships is asymptotic. That means it levels out. As you get bigger, you get less. Yeah. And by the time you're doing 400,000-ton ship, you're really not saving much. Mm-hmm. But these ships came into the market just about the time that the oil moved out of the hands of the oil companies into the hands of traders. Yeah. And so early 80s, a lot of these ships are being chartered by the traders, and the traders, they liked a 2 million barrel parcel. Yeah. VLCC. They didn't really. Who wants a 400? A 4 million barrel parcel was too big, and because a lot of the trader parcels were sold on the voyage, and you could only sell them if the destination was accessible by ULCC.
Yeah, yeah.
And so if it wasn't Loop or Rotterdam,
Exactly.
So the traders didn't like it very much, but the owners did. And it was interesting that the biggest ship, which I think it was Minos Kolokotronis built, the ship that was sold to CY Tung, and became the Seawise Giant. And he actually had it extended to 550,000 tons. Just so, and that was the end of an era, and it became the Happy Giant,
the Happy Giant,
a KG, a KS company.
KS company in the original, but that's that. I think the last one was scrapped in except for the Euronav vessel, which still isn't. But out of the old era, I think the last one was scrapped around 2005, 2006.
Yes, those were the ones built.
And they all sort of, in a few odd ones that remained in the market, they were like a storage only. I mean, no one would sort of move oil on them anymore.
Yeah, I mean, what the market does is it doesn't. A ship's got to be really terrible to be. The market will find something for it to do, and a lot of them ended up in storage and things like that. But one of the main roles of the shipping market is to find the best employment for ships which were probably built 30 years ago or 20 years ago and are not ideal, but somebody will charter them.
Somebody will charter them, exactly. Perhaps with a slightly different business model. So it doesn't seem like is the story appealing to Panama Canal, because for the vessels that actually the maximum size of a vessel going through Panama Canal, they're still quite flexible in terms of the size. So they can be deployed on different routes, whereas the ULCC probably could be compared to a container vessel of 30,000 TEU if it existed, right? I mean, because it seems like we've gone into 24,000 now, and we've reached a plateau, which is essentially a vessel you would deploy from Far East to Europe. That's where they normally operate. And there were people talking about larger sizes, but it doesn't seem to be the case anymore. At least I haven't heard one.
Well, I mean, I to be honest, I don't know exactly what the water prognosis is for that for the new canal, but the part loading has always been a way of getting around the Panama. I mean, for many years, the standard Panamax parcel was 55,000 tons for a 70,000 ton ship, and so you could get through the canal, and that works fine. I think it's one of these things you just have to wait and see, and a bit bad, But the obviously getting access from the Pacific to the East Coast for very big container ships is an issue.
Well, before we moved into more futuristic subjects, one more operational change, or perhaps it's not actually operational, because it does change a lot for tankers. But perhaps we're witnessing a much greater change, and now I'm into geopolitics. We're not going to be discussing politics here, but of course we have ongoing conflict in Ukraine, which you can arguably say is more like an East and West conflict, and perhaps it's the beginning of a new order of things. So I sort of call it changing from a bilateral or bipolar, should I say, world where you had the US and Russia as the two major superpowers. Now you introduce countries like China and India, which have grown so much more in power because of the economy, and they obviously take much more formidable place in the world. And let's leave politics aside, but I mean, it does seem to create new trade patterns. At the moment, we obviously talk sanctions, West to Russia. But we do see that, of course, I mean, shipping, well, Russia had to find its new trading partners. Europe had to find new suppliers. So all of a sudden we've got to, as I was told, we don't no longer call it a shadow fleet. Now we call it a parallel fleet, because they are not all illegitimate ships involved in that trade. So I can see that, the complexity has just gone up a notch again. I mean, what's your take on it? Do you see further progression here? Or?
Well, I think the danger here, in a way, is that you overcomplicate things. Yeah. I mean, there was a
we're already in this stage.
Yeah, I mean, I hate to go back to my book, but when I was doing the first edition, I was teaching at CAS at the time, and this whole question of how do you look at the world economy from a shipping point of view, and I sort of had this idea of the West Line, which is the idea is that seaborne trade started 2000 BC in the Lebanon, in the East Mediterranean, and it's gone in a straight line. The centre of trade's gone in a straight line west ever since, and it actually works surprisingly well. It went from the Lebanon to the Aegean, then to northwest, up the right to the northwest Europe, across the Atlantic, and we bring in northeast coast of America. Then you jump over to the Pacific, and Japan came in as a massive, 50 years ago, Japan was the miracle economy and the source of all the developments in trade and shipbuilding. And then it moved from Japan, the focus moved from Japan to Korea.
Korea first, yeah.
And when I did the second edition, it was just looking as though it might head towards China. And sure enough, by the time I got to the third edition, it was in China.
Yeah.
And China is suddenly the dominant force, which Japan had, on an even bigger scale than Japan had been 25 years previously. And now we're bringing in India is really getting some momentum in a way that, we've all been asked this question, when's India going to develop for years? And it looks as though they're getting the show on the road. And also the Middle East seems to be moving into a new era. What an interesting area, and how many things might happen there over the next 20 years. And then finally, Central Asia, which has been, sort of off the map for many years.
Yeah. If you look at the GDP now, you see China sort of on top of an S-curve and with not that much growth, but you start pointing into Indonesia, Philippines, Vietnam, all those countries. I actually put them all together as quite a few hundred millions of people over there. And that's where the main source of demand is now sort of hiding in.
I think with China as a maturing economy, the North Atlantic getting very mature. Europe is a completely different economic structure from Asia. The Asian countries are pulling together, and really Indonesia, Malaysia, you're starting to see Vietnam, a tremendous. It's been going on for years. You get used to it, but it's building critical mass all the time. So, I think perhaps the temptation. Your question was about emerging trades, but I think each era brings its own network of trades, and perhaps the job of the shipping industry is to adapt, and the adaptation is not always easy. My own personal view is that I think the globalization, if you call it that, of the last 50 years is very much about the sort of big ships, deep sea trades. And I think where the Asia and the long haul stuff and to Atlantic trades and the very big ships in every trade sector, I think we're probably moving back to an era where we're going to see a lot more focus on the short sea trades and the integration of maritime regions with short sea shipping, which really means you can do just in time. In an ideal world, you do for the delivery of containers what Amazon has done for the delivery of packages, which is, I'm not going to, extremely convenient, I would say. And if we can do even a fraction of that, so places like the North Sea become new areas of trade. Asia, I think the Asian countries would benefit enormously for networks of fast, integrated, small electric ships, container ships, all sorts of ships operating with the same sort of information technology as makes it possible for Uber to book the cab for you that's sitting right outside the restaurant you're in, which was
just-in-time deliveries, right?
It wouldn't have happened, 10 years ago. That's the information management technology which was developed for things like Uber, just needs to be brought into the shipping industry. And that takes us into this whole question of how do you get into digitalization in a business which is so fragmented that most people are lucky to have ever been on all their ships. You know?
Yeah, absolutely, absolutely, and particularly in shipping, and especially if you start looking into short sea shipping, that's even more like you've got loads of one ship, one owner, sort of small companies, and then you probably need to introduce a certain degree of integration before you can even start talking about rolling out bigger systems that would serve the purpose you're just talking about.
Well, I think this is but one of the things that shipping is very adaptable and quite eccentric about is company size. I mean, the average, there's 26,000 shipping companies. Well, this is a couple of years ago. About 13,000 of them own only one ship. But they are genuine ship owners, but they own one tug or one ferry that's not a weakness, it's a strength, because, you know, as one of the old tramp owners, a chap called Hector Griapios, wrote a very good book in which he said that a tramp owner could carry his office under his hat, was the phrase. Yeah. This is a 1950s phrase. You know, he got his office under his hat. But you could now, you know, you could run a small shipping company off your smartphone. And who's to say that the human mind is still a wonderful thing despite artificial intelligence? And who's to say that one man with a smartphone and a couple of good assistants can't run a small fleet of ships very, very tightly, especially if it's someone who's really got his finger on the technology, you know?
Well, absolutely, absolutely. And then with all that technology made available to you right now, I think I don't remember, but I think it was Elon Musk who once said, you know, today's an average Joe has access to information that the most powerful man had 30 years ago. And you have it on off your smartphone. So what would stop you to employ all this technology to run much more complex businesses? And I completely agree with you.
Yeah, but the decisions in shipping are difficult, and they're a mix. They're an interesting mix of intellectual, sort of factual decisions and personal people decisions. I mean, you know, a lot of the important decisions are to do with the ability of one person to connect with another person, out of which comes some sort of transport deal, you know, and then particular ship owners' ability to connect with cargo owners, yeah. Which is interesting because, you know, cargo owners, 80% of the tanker fleet, and the same thing for the bulk fleet, is on the spot market.
The adversary nature of the spot markets, decentralization of the shipping industry, or as Martin would later name it, house divided, after the famous Abraham Lincoln speech. It was an excellent moment for us to take a little breather before we move to the second part of the interview. In part 2, we will discuss yet another disruption, perhaps the biggest challenge of all, the transition to clean fuels. A massive transformation will almost certainly not be achieved if the house continues to be divided. Everyone agrees shipping will change. A new phase of globalization, or perhaps regionalization, more advanced digital systems, zero emissions regulations, and green market dynamics seem certain to change the current business model. How will it change shipping companies? Stay tuned for the second part of this episode, where we will discuss what companies should invest in and when. Thank you for joining us for this episode of DNV Market Views. Although we haven't said goodbye to our guest yet, I would like to thank Martin Stopford for being with us today and sharing his vast knowledge and insights. As always, we encourage you to explore all of the resources available on our Maritime Impact online platform at dnv.com/mi. Thank you for watching, and we'll see you next time.